Hi everyone, and welcome to Swissquote's Daily Market Talk. This is not me, this is my avatar. I am sorry I wasn't here yesterday. I had a laser operation to correct my vision and could barely see anything. But today I am feeling better. I won't appear in front of the camera, but you can hear me speak. So tune in, the real me will take over from here. That's enough fun. So yes, guys, they did it. The Fed dared announcing a 50 basis point cut this week. Plus, it wasn't a hawkish jumbo cut, mind you. It was a big, fat interest rate cut that came with the accompanying statement that if the Fed had seen the July's jobs numbers before last decision, the decision before this one, well, they would have cut by then, and that there will be more interest rate cuts in the future to make sure that the US jobs market gets the support that it needs to remain healthy. So the funny thing here is that the US jobless claims fell to the lowest levels in 4 months, showed yesterday's data. But anyway, that's the decision leg of the game. Then we had the famous dot plot from the Fed, which also showed that the Fed members anticipate another 50 basis point cut before this year ends, implying about 225 basis point cuts in November and in December policy meetings. And finally, the median projection implies 425 basis point cuts in 2025. So that's quite clear. It's clear and it's dovish. Now the question is, what could go wrong, right? Well, as I was saying earlier this week, before the Fed decision, the major risk that I see here to all this optimism about the end of the Fed's tightening with a fat 50 basis point cut is if we start seeing strong jobs and, more worryingly, strong inflation figures in the coming months. Because if that's the case, the worries that the Fed may have acted too fast and too hurriedly could resurface, and the possibility that inflation could come back in force would eat the Fed those alive. And that's also probably why the Fed President Jerome Powell said that they are in no rush to deliver more big rate cuts in the future. But in vain, the market is already pricing a 70 basis point cut from the Fed before this year ends. So let's hope that the future data, especially the inflation data, doesn't show strength. But you know what? Citi's Economic Surprise Index is already showing signs of improvement, if anyone cares. But anyway, if you look at the market reaction, the reaction was mixed really. The S&P 500 first hit an all-time high level after the FOMC decision, but closed the decision session in the negative, and the treasury yields and the US dollar rebounded. But then the bulls, the risk lovers, were back in force yesterday, and we saw a beautiful rally in the global equity space. The S&P 500 rallied 1.70% and hit a fresh all-time high level. It's 39th record level this year. The Nasdaq 100 jumped more than 2.5% yesterday. The Dow Jones Industrial Index extended gains to a fresh all-time high level as well. And the Russell 2000 Index closed more than 2% higher. And here in Europe, well, the Stoxx 600 index gained more than 1% as well, on hope that the bold move from the Fed this week would maybe also motivate the European Central Bank to have a better grip when it comes to interest rate cuts in Europe as well. And the FTSE 100 in the UK added 0.90% yesterday, even with a strong British pound after the Bank of England kept its rates unchanged. And as Governor Bailey said, it's vital that inflation stays low, so that they need to be careful not to cut too fast or buy too much. It almost sounded like a response to, well, what to me looked like a quite irresponsibly high cut from the Fed the day before. Now, in the FX markets, the US dollar remains under pressure, obviously, as the Fed's bold 50 basis point move doesn't look like it's deuced the other major central bankers whose economies need rate cuts more than the US does, by the way. So the euro dollar is preparing to test the 112 offers, though I expect the upside to remain limited, as the Bank of France, for example, cut its inflation forecast for next year to 1.5% this week. That's well below the European Central Bank's 2% target. And across the channel, cable is doing great, as I said before, but the recent slowdown in UK inflation, well, didn't lead to a more dovish decision from the Bank of England. On the contrary, guys, only 1% out of 9 voted to lower the interest rates in the UK yesterday. So, no wonder cable advanced to the highest level since March 2022. But here as well, I think that the pair could see its upside potential limited by austerity in autumn budget, which would require a softer approach from the Bank of England moving forward. And finally, last but not least, the Bank of Japan maintained its interest rates unchanged at this week's monetary policy meeting, as expected, a decision that could strengthen support near the 140 psychological mark in the dollar yen. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and hopefully in the regular video format. And until then, well, good day trading and have a lovely weekend.